everyone. Welcome to our Q2 2024 Market Insights webinar. Thank you so much for joining tonight. We're here with a great audience. Looking forward to really aiming to unpack complex economic data, current events, and their implications for investment strategies. And our goal here really is to provide actionable insights and foster an engaging dialogue with everybody that's showed up. So for everybody here right now, thank you for joining. I know we'll have some trickle in as time goes on, but why don't we go ahead and kick it off? Andrew, you want to go ahead and introduce yourself, and I'll start sharing screen here.
Perfect. I'm Andrew Tudor, investment advisor here. Wonderful to see some of the folks on the call. We also are really excited for our intern Helen Chen. So she's been working out of Michigan, and she's a rising senior there, doing a wonderful job on our team here as well. So excited to share some insights and dive into some market commentary.
It's great. My name is Jason. I'm the firm's chief investment officer. I've seen a number of you all before in prior quarters, but for you that I haven't, I see some unfamiliar names here. Thank you for joining. For everybody who watches on recording, I'm really trying to share some expertise on impact investing, dedication to fostering wealth equity, and really highlighting some of our thoughts related to investment markets, and complementing Andrew's extensive experience in planning and working with institutions on integrating their values into their investment policy. So we've got a great agenda here tonight, and to go ahead and get it started, well, I guess before, just a bit of a housekeeping. If you have questions or comments, please come off mute. We will pause every few slides to just see if there are questions. We'll also accept questions in the chat, so feel free to throw questions in the chat. We will address them in real time as we go along. On the topic of making the complex simple, and really our role here as advisors at Zenith, I think we want to focus on the key themes to start this off. These themes really influence the current landscape, right? Sustainability transitions, policy shifts, inflation dynamics are all really relevant as we think about economic context today. And you can really compare the economy to like a complex ecosystem where various factors like climate, food supply, and other things must be maintained to keep balance and maintain stability. So think of it like a food chain almost, and these are kind of the most important pillars. Just to start off, I think, and probably the most relevant is monetary policy and inflation, right? I think with monetary policy, right, this is really focused on our central banks and the policies that they use to, slow down or speed up our economy. And they're really looking at inflation trends and unemployment data to make these decisions. We're not really expecting, moving to inflation, the Federal Reserve to make any type of interest rate changes or cuts until the fall. And we've really seen a stance on inflation that's been relatively aggressive from the Fed to maintain rates higher as inflation has waned over time. I think we've seen some factors play out with inflation, like stronger productivity growth. Think about AI, which is down there in digital disruption, but also declining rent inflation, moderating wage growth, and why those are important to the Federal Reserve's decision on how they will stimulate or slow down the economy. There are some things related to global growth as well that I think are important. And, just like as you think about the global landscape and how that impacts inflation and just the economy, a recent report showed that the Pacific Island nation of Tuvalu saw a 15% reduction in GDP due to severe climate-related disruptions, right? So it's not just like things going on in geopolitical tensions and trade, but also natural disasters and other things that are impacting the global economy that will have an impact on total economic output. I'll kick it over to Andrew for the last three.
Yeah. And building on those inflation dynamics, some of those inflation dynamics that we see playing out domestically, waiting to drop rates, but in some of the Eurozone and other parts of Asia, some of their national banks are already starting to drop their rates. So that is really shaking up what we see from bonds and from just productivity in general. Speaking of productivity, though, the digital disruption, we hear about AI. I'm sure folks are seeing and hearing about AI. Quick stat, NVIDIA, which is one of the biggest purveyors and pressers with chip manufacturing and AI, year to date, as of today, up over 150% for their stock price. QQQ, which is a ETF that follows the NASDAQ and is really tech focused, up over 20% year to date in less than 6 months. And so we are seeing that digital disruption, and in a lot of investor calls, investors are asking companies how they plan to capitalize or integrate AI into their business models. And we expect that to be a big driving force going forward. We also think about sustainability transition. We work with clients who are asking for more sustainable investing options. Sustainability can be put in a lot of different ways. We can think of ecological sustainability with waste management and carbon footprint, but we're also thinking about social sustainability and government sustainability. That, what does it look like for a company to have policies, procedures, and operations that can continue to sustain long term? We feel that sustainability, whether it be environmental or social or governance, is vital to how we evaluate companies and portfolios. And we expect that in the future to continue to be a big factor. And then when we think about geopolitical tensions, calling out the elephants in the room, right? A presidential candidate assassination attempt in the United States, wars, different parts of Europe and in Asia. But also when we think about tensions, not specifically to trade, but tensions in general, over 60% of the world population will be going to the polls in one way or another this year. And, in this country, a lot of times I feel we take transition of power for granted, but that is not always the case. And we also know that those geopolitical tensions really spark anxiety and fear, and markets are based on fears and hopes of investors. And so those have been the themes to date, and we expect those to continue to be the themes as we think about how we want to craft portfolios and how we just want to think about the markets going forward. Anything you want to add to that, Jason?
I do. I mean, I think even outside of the presidential election, which we'll cover a little bit here in a second, just thinking about geopolitical tension, in the UK, a few years ago when they went through the Brexit, process, and the significant drop in foreign direct investment that had on the country, the UK, the Eurozone, and the implications for broader markets is just one example of how certain events can play out and really have a big impact. And, the election transfer of power, I think, is one risk, but there's plenty others, right? We've got conflict in the Middle East. We've got conflict in Eastern Europe, Russia. And I think there's a number of areas that, geopolitical tension could play out. And we just got a question in the chat. I think it'll be a good one to maybe keep us moving off this slide. We could spend all night on the slide. Thanks for submitting. How might potential policy shifts under different administrations impact specific industries or sectors? Thanks for the question. I could probably take this. I mean, I think we've already started to see this moderate and play out. So, ever since the assassination attempt on President Trump, former President Trump, right, we have seen almost like a shift, right? We've seen technology do so well year to date. Andrew referenced NVIDIA. McKinsey predicts AI could add to $13 trillion in global economic activity by 2030, right? Technology is at the forefront, I think, of innovation and long-term returns for investors. But since that assassination attempt, technology has actually been a little laggard, and the sectors that have done really well in anticipation of a Trump, election victory are energy, small cap equities and stocks, a similar outcome, to the 2016 election when Trump won previously. I think people are kind of seeing that trade and taking advantage of the fact that it's likely, and the predictions would suggest that Trump's going to win. So I think if we see that type of victory, by the time Trump gets elected, or if he gets elected, that trade will probably already lose its legs and the market's going to move on. So I think these are things that are all in speculation of what, may occur. But by the time the actual election results are in, I think we'll have already kind of like seen, and the market's going to have been priced in, what the most likely option is. Good question.
Great. Well, we talked a little bit about inflation and policy. This slide really helps to see. So in the green, we can see, the Fed's target of 2% stays steady. Also, expected inflation is pretty steady as well, around 2%. When we ask and surveys are put out there, this source is from the Bureau of Labor Statistics. Even when inflation was near 7%, the expectations were that inflation would be around 2%. And so with those lower expectations, Jerome Powell, the Fed team, they're really not looking at expectations. They're not pricing in geopolitical movements. They're really only making their decisions based on labor data, productivity data. And for those reasons, we are expecting that inflation is coming back down. But, they have not made a quick decision to drop rates. And some would say rightfully so, really trying to avoid a drop in rates that skyrockets inflation again, to be a little bit early and miss that safe landing. So as we look at this, the expectation is that inflation is going to continue to drop. But whether rates follow in the fall or in the winter, at the beginning of this year, people were pricing in 3 or 4 rate cuts for 2024. Now, halfway through the year, 1 or 0 is where we're sitting as of now. And so with this being fluid, expectations really do need to shift with the data. And hopefully that's what we see going forward.
Absolutely. That's well said, Andrew. And, I think just furthering on this and the impact of moderating inflation, the Bureau of Labor Statistics just reported a 2.3% decline in consumer goods prices last quarter, which indicates really a slow but steady normalization of prices and inflation. So as we move on and as we really think about what this means for investors, right? You can see here in green, we've got the inflation percentage peaked up over 8% in 2022, now is moderated down back under 4%. Remember, Andrew just mentioned the Fed's target is 2%. So we still got some ways to go before they feel good about where inflation is in the economy. And then in the blue line, you can see the federal funds rate. So that's interest rates, right? That impacts things like your mortgage. That impacts things like your borrowing rate. That impacts, discounted cash flow rates and how we value assets and companies. So you see, as inflation rose, the Federal Reserve kind of lagged, but they also rose the policy rate. So as inflation falls and has fallen, they've maintained that rate to be steady, but we anticipate the blue line going down over time, which should create a good backdrop for investors, right? Particularly those that are looking out into the future and into longer duration investments like technology, like longer duration credit and mortgages, right? 30-year mortgages versus a 15-year. The rate difference there is kind of indicated by where we see policy rates. So, I think as we've gone about our investing journey and as we work with clients, these are really the most important elements of their portfolio. But, this is long-term big picture thinking. I know we've got some near-term current events that are going to make impacts on returns here over the next 6 to 12 months. So, Andrew, what do you think?
Well, I really like this slide. I've said this a lot. I really like this graph. I think it does a good job of zooming out and seeing whether it's a Democratic or Republican win in the presidency. It doesn't change long-term the trajectory of the economy as much as we'd like to think. And so, we're looking at some of the, even through, we can start in the most recent with, the Obama presidency, right? That presidency through Trump, through the Biden administration, minus some of the, steep declines from COVID, has been relatively normal on a long-term cycle for the economy. And so our long-term strategy, there are some policies that will matter specific to sectors that we think about, energy specifically, healthcare specifically. Some of our, when we think about energy, whether we think there'll be more investment in traditional energy sources or new emerging energy sources. Those are some of the tactical plays inside of a portfolio that we think really matter. But from a long-term perspective, whether or not one person wins or loses the election hasn't changed the trajectory of the economy very much, at least when we zoom out and see that. So that's why we're really, it's important to look, even in the last two elections, right? Trump versus Biden, so post-election, those 2 months after the election day, 6.16% in the Trump presidency, 14.33% in the Biden presidency. So, I think it is important for us to see when we zoom out, does it change the trajectory of the economy? And in a lot of ways, from a big picture perspective, it doesn't as much as we'd like to think.
Yeah, Andrew just hit on some of these statistics, but I think for long-term investors who are investing in diversified portfolios that are getting index exposure, right? This chart is looking at the S&P 500 index, so you're getting exposure to all sectors in the kind of the major stock market. As you break down intersector, like there may be some pretty big deviations, right? Like I would expect energy, small cap stocks, companies that have pricing power, uh, really sectors that have benefit from higher interest rates, like financials, like higher margins,
Mm.
Probably to do well in a Trump victory, and, technology and healthcare and some of the things that, I think have done well over the last year to date, I think are things that under a Biden win or a Democratic win, would be, I think like to expect, but from a total index level, and this is the reason that we preach diversified portfolios here at Zenith for our clients. We don't always want to be betting on sectors, but to the extent we can tilt and make adjustments, I think those are things, two themes to really consider there. Before we start going on to our expectations on the world economic outlook and investment performance, let me just pause there and see, are there any questions or thoughts in the chat or kind of from our folks on mute? Feel free to come off and pose anything. Great.
I've got a question for you, Jason.
Sure.
Because I see some clients that I'm used to, and there are folks who are home buyers or potential home buyers, or even some of our clients, home sellers. How do you see interest rates interacting with like home buying, or people who may be waiting for interest rates to drop to buy, or watching them from a purchase standpoint with their real estate? Any thoughts on how they should be thinking about real estate in this market with this interest rate economy?
For sure. Well, look, affordability is difficult right now with elevated mortgage rates, right? So like the same monthly payment that you would get for roughly like $300,000 house when interest rates were what they were 2 years ago is like the same that or $900,000 house is the same you get for a $300,000 house at the current rate level. So like it's a lot more difficult to purchase a home. Um, at the same time, I think we've also seen a housing supply, and this is nationally, your local market may change, but a housing supply number that is not that high. So new homes being built has been really slow. Homes in the market in most markets have been really low. So there's a lot of competition for the existing home stock. So for new buyers for homes, it's tough because a lot of these are going like for, all cash or like low kind of mortgage amounts and high down payments, no contingency, right? So I think as, rates continue to stay high, that's going to slow down the demand, right? Like it takes some time for higher interest rates to set into the market and change consumer behavior. We're starting to see that slow down with consumer spending. And I think as we see demand slow, then we may see prices moderate, right? And I think it's been interesting to just watch like, okay, well, rates went up, rates tripled or quadrupled in some respects from where they were, and housing prices haven't really changed, right? Like I look in my local Redfin and they send me the email every month and it's like, oh, prices went up 2.2% in your area. It's like, how is that possible when, rates quadrupled? So I think we've seen prices that haven't been tied to rates and affordability because there's so little supply in the market and there's still a lot of demand. But as high rates set in, I think that's got to change, right?
Yeah, I agree. I'm interested, and me being one of those people, right, on the cusp of possibly buying, and seeing that there are houses that are staying on the market longer than previously expected because of the high rates. And the question being, do you make the purchase at the higher interest rate, wait for rates to drop and then refinance? Or do you wait around for those rates to drop before you make offers, and you might be one of many? So there is a supply, demand, interest rate trade-off to do, and appreciate your insights on that.
Yeah, for sure. Absolutely. Good luck to folks looking for a house. I think that, getting into just world economic outlook. So we want to share these themes. We want to share our policy and just like broader economic outlook. And then now we're starting to get into actual output. So this is going to be the, global outlook here, along with like capital market assumptions and returns to follow. Right. We've really got a steady global growth projection at 3.2%, across the board for the world output. And that's like world economic output or gross domestic product, gross global product, I guess, in this case. And I think we really want to focus on the different growth rates between advanced economies and emerging markets, right? So you look at the top blue line, advanced economies, it's US, it's Europe, versus, emerging markets like India or, Brazil, and the difference in growth rates in these different economies. And we've been preaching, to have a diversified portfolio. Having international exposure in your portfolio is important for a number of reasons. One, growth rates are different across the world. So just looking at this output standpoint, growth and GDP should translate into equity market returns provided things are efficient. But then secondly, currency dynamics, right? And we didn't talk about this in our key themes, but the US dollar has become extremely strong from a currency's perspective as interest rates have gone up in the US, making the dollar and the yield here more attractive for international investors. That may unwind as we see a more accommodative Federal Reserve stance in lowering rates. So that could be something that benefits international equities and assets as they compare to US assets moving forward. So I think focusing on that output internationally, but also focusing on the currency dynamic really builds the case for international equities. I feel like I always say that, and then we still see US dominance kind of in returns, but all it takes is that 1 year, Andrew, where, we see the US lag and international kind of power returns for a global portfolio, and it really changes, I think, the dynamic for folks and smoothing out volatility of their returns.
I agree. And speaking of volatility of returns, this is a great chart. So if we look left to right, on the right side is higher risk as measured by standard deviation. On the left side would be the lower risk asset classes. And then from top to bottom are historical rates of return. So Jason nailed it. The United States equities has been leading the global market, pulling up global equities entirely because global equities include US. And then right under that, we see non-US developed economies. We saw what those were, most of the Eurozone and some other older, more developed economies there. And then slowly trailing behind is emerging markets. And so when we look at that, these are historical performances. It's important to always know, markets are cyclical. Asset classes are cyclical as well. So, we have a practice of rebalancing portfolios because we know that after really good years in certain asset classes or certain companies or certain sectors, there's typically sometimes a lull, and some of the lower performing asset classes, lower performing companies, usually can hit their stride and really come up. So the United States historically has outperformed, and we appreciate that. But it's really important that we're keeping and we're holding those global equities, non-US developed equities, and then also building in our fixed income sleeve. So these fixed income, they're lower risk, they're lower return. But in years where equities go backwards, in years where, global, we've seen the triggers, right? With COVID, with 2008, 2001, we see that it's a domino effect in equities a lot of times, that one country can kick off, and with international supply chains being so interconnected, all of them suffer and all the equities suffer. And so having a portion of the portfolio in fixed income or in bonds where we can be safer is really important. we'll talk about some of the themes that we're looking for in the future, but looking at global fixed income. So some of the dynamics with the pricing of interest rates is as interest rates drop, previously priced bonds become more and more valuable. And so folks are waiting on that in the US fixed income economy. But as we alluded to earlier, there are global banks and global countries that are already starting to drop their interest rates. And so what that does for their previously priced bonds is that they become more and more valuable. And so we're looking at, how do we make sure that we're not only holding fixed income, but we're also holding global fixed income so that as rates drop, we can get some of the increased return from those fixed income. But then also, if we wake up in 6 months, a year to 2 years, and the US economy starts dropping those rates, we're still holding fixed income to lock in some of those intermediate and longer term bond prices that we really appreciate right now.
For sure. And I think that dovetails nicely into just like our updated expected annual returns by asset class. So Andrew kind of talked about the risk return spectrum, and on that last chart being kind of the furthest and up and to the left is ideal, right? The further left and the higher you are, the better. And this is really just a numerical representation of, where we feel like over the next market cycle, we're going to see, the strongest, and just like where expected annual returns are going to be. We've lowered our outlook for US equities based on the run that we've seen so far year to date, right? And we've raised our expectations for international equities. You can see here that our alternative investment asset classes, particularly private credit and private equity, have gotten more attractive as we've seen less liquidity in those markets. We've seen, changing pricing, particularly in the private equity market, with lower multiples and higher discount rates because of higher interest rates, playing into valuations, and a much more attractive investing environment with higher yields and higher expected returns moving forward, as we've seen those price, pullbacks that we really haven't seen in public markets. So like we said in the last quarterly markets webinar, like the opportunity to invest in private markets, whether it's private equity, whether it's private credit, whether it's early stage companies investing in their equity or lending to them, those are ways that you can really add some alpha and outperformance to your investment portfolio. I know we show ideas here at Zenith, but I think as you think about structuring your portfolio and really generating returns that meet or exceed these expected annual returns, focusing on that, focusing on, structuring those appropriately, I think is really critical. Which I think dovetails into our key takeaways here, right? And I feel like the importance of maintaining patience and a diversified portfolio in a volatile market environment is critical, right? And I think we've heard it before from like Warren Buffett, right? The strategy of long-term investment in diverse sectors and companies will provide the best outcomes. And even though we've got near-term uncertainties with geopolitical risks, with our own, U.S. presidential election, with inflation potentially running hot, even though we've seen it moderate, are all things and risks that I think investors should be aware of in the short term, but not necessarily take action on in the short term. Andrew, what else do you think here on this list that's important for folks?
No, I agree. The diversification is important. And one of the biggest things that we see with, non-professional managed portfolios is diversification within an asset class. So, if you are holding a all US large cap, the S&P 500 or the Fortune 500, and feeling really good that you are invested in 500 different companies across different sectors, but we're not in different asset classes, right? We're all bunched in one asset class. So really helping folks to think through and move beyond just diversification to asset allocation diversification, and then also looking globally as well to make sure that we're holding in different countries so that we're not tying all of our eggs in one basket. And then as we think about, technology or healthcare or energy or finance or consumer staples, if we think about some of those things that we're more excited about, that we can, be strategically and tactical and leaning more into those areas, not necessarily buying an entire maybe ETF where my entire portfolio is tech or my entire portfolio is healthcare or energy or wind or solar, right? And so I think we should start asset allocated and then tilt and lean into some of the areas where we feel good and confident that those will have great area to run, whether it be based on politics or market cycles or just our own personal themes and thoughts about what we want to be invested in, can be really, really helpful.
For sure. So I think that's a good dovetail into just recent portfolio management themes on our end. Just want to share some things that we've been doing on behalf of our clients as we manage portfolios. Um, you know, we're thinking about three major themes, right? Enhancing credit quality, increasing growth exposure, and extending portfolio duration. Enhancing quality, right? This means, investing in companies that have higher credit ratings and have a lower chance of default than investing in riskier credit, because we've seen the impact of higher rates play into the market. Defaults have remained to be pretty low, but I think as we look ahead and we look at a changing Federal Reserve stance, we could see defaults increase, and those invested in high yield bond funds or riskier credit, may realize some of the volatility as defaults could expand and increase in the economy. We've seen it on the early stage front. Early stage companies tend to move faster in the default cycle, and we start to see more M&A and just like defaults from early stage investors. Continuing our growth exposure, I think this is really critical and matches and kind of married with the increasing duration, but making sure we're maintaining exposure to high growth stocks in both the US and developed markets. This is really related to technology, innovation, and AI, sustainability trends that are allowing companies that are focusing on growth and have earnings dated way out in the future from a duration perspective to perform better in the short and long term. We've seen it year to date. As rates fall, I think that is something that Andrew alluded to a little bit in the last slide, but as rates fall, things that have cash flows and earnings dated further out tend to have a higher sensitivity to rates falling, and the prices tend to move faster than those that have shorter term earnings or cash flows. So making sure that we're investing for growth, that we're investing for the long term and long duration are changes that we've made and kind of reduce some of our value and core exposure and moved into growth sectors has been a theme with our portfolio. So, that's really all we had prepared. I know we said a lot there. Andrew, we ran a little bit longer than we typically do with our talking points, but wanted to just pause. I know we paused earlier, but any questions or thoughts or feedback? How are folks on the call feeling about their investments today?
Garrett Mason's giving us a heart.
All right, yep, got a like. Appreciate that.
I appreciate you all putting this together. I know I'm a new client, but all the things that you sent out, I follow you all on LinkedIn. Just keep it up. I really appreciate certain seminars like this. So you have my support. Appreciate you both.
Thanks, Mr. Mason. Appreciate that. Thanks for your trust and confidence.
That was a good segue, thinking about, more content, more things like this, right? That this QR code does help. So if you'd like to, get a free portfolio risk analysis or values analysis, this QR code will lead you there. Also, we spent a lot of time thinking through Market Mondays, putting out updates on Instagram and on LinkedIn. So please follow us there and engage with that content. Our goal is to make it as relatable, approachable as possible and keep you informed. And we do that on an ongoing basis weekly. So follow us there. And we appreciate it.
All right. Thanks, everyone.